The Market Brief Daily, because your money moves faster than headlines. The CEO of JPMorgan Chase, America's largest bank, has just issued a warning that's turning heads across Wall Street. Jamie Dimon says the U.S. stock market could face a significant correction within the next 6 to 24 months. And according to him, it's not just the usual market cycle. It's the result of decisions that have been building up for years. When the man who runs the world's most powerful bank speaks, investors tend to listen. Now, Jamie Dimon isn't just another CEO making noise. He's one of the few banking leaders who successfully navigated the 2008 crisis. So when he says the system looks unstable, it's not panic, it's experience talking. This week, in an interview with the BBC, Dimon said global uncertainty, massive public spending, and rising geopolitical tension are creating the perfect mix for financial volatility. So, what exactly is he talking about? According to Dimon, markets have become too comfortable, almost numb to the risks piling up. Government debt has reached historic highs. Spending continues to grow, even as the economy slows down. Inflation, while lower than in 2022, remains sticky, and every new dollar printed or borrowed adds pressure on the dollar's long-term strength. He also mentioned remilitarization and global conflict risks, two factors that can disrupt supply chains and drive prices up again. In short, the financial system is stretched thin, and the margin for error is getting smaller. Now, Dimon didn't say it directly, but his comments imply something deeper. Washington's habit of spending beyond its means is catching up. The market can't rely forever on government intervention, stimulus checks, or trillion-dollar deficits. At some point, investors start asking, who's going to pay for all of this? And when that happens, confidence drops. First slowly, then suddenly. Dimon's warning feels less like a market prediction and more like a wake-up call. You can't build long-term prosperity on short-term fixes. If you have a 401k, own stocks, or even just care about your job stability, this affects you. A market correction doesn't just hit Wall Street traders. It can slow down hiring, freeze investments, and drive up borrowing costs for families and small businesses. When interest rates stay high to fight inflation, credit cards, car loans, and mortgages all get more expensive. That's why Dimon's warning matters. It's not politics, it's economics. So what's next? Dimon still believes in the resilience of the American economy, but only if policymakers and investors start acting responsibly again. That means focusing on productivity, energy independence, and smarter, not bigger, government spending. In his words, hope is not a strategy. The bottom line? Whether you agree with Jamie Dimon or not, his warning is clear. Markets don't stay calm forever. The question isn't if there will be a correction, it's when, and how prepared you'll be when it comes. Thanks for watching the Market Brief Daily. If you found this helpful, hit like, subscribe, and tap the bell.